So good morning, everyone, and you are welcome to our lecture on standard costing and variance analysis. All right, this is one of the easiest places you can pick up marks because usually it is just based on formulas. All right, but you need to understand what you are doing as usual, right? That's why I take my time to explain things. So let's look at standard costing and variance analysis. All right, so now here, this is how our lecture is going to be. All right, so this is how this series is going to be. We're going to start with standard costing. And it is something that we have done before. A standard means that a predetermined cost. So you want to price something, you have to have a standard cost, what you think the cost should be, all right? And we've basically done this using marginal and absorption costing. You remember? Marginal and absorption. We've done this using ABC when we want to determine a cost. Do you remember? We've done this using target costing. We've done this using life cycle. All right. So all these things are things that we do. That is what every management accountant is for, to price. So how to cost the thing. All right. Then when you are able to, so all these things are just, they are like a budgeted cost that you think a product should be. All right. So that is that. If you remember our last lecture, we did some comparison when, if you check the flex budget, we did a comparison between the budgeted and flexed it to with the actual to see something. And because of that, when we determine our standard cost, we need to measure it against the reality, and that will give us the actual. So from here, we are going to actually go in there to know the purpose. We are learning purpose, and which I have just explained to you, purpose and the types. And so when I start in there, I'll tell you about some types of ideal standards, attainable standards, and all those things, basic standards, and all those things. All right, so I will go in there to show you how this place looks like. Now, from there, we will learn how to compute a standard cost. So with its computation, all right, so you do standard cost here, explaining this one, then we will do computation of standard cost. All right, standard cost computation, where we will revise a little bit of these two, right? So marginal and absorption cost. All right, so standard cost computation. Then when we are done, we are going to do variance analysis. And that will lead us to basic variance. All right, so we are looking at variance calculation and analysis. We will be looking at the basic ones anyway. So let's say the basic. Then from the basic, you should understand that it's like doing a P&L. So here we have our sales variance, and we need to do less cost of sales variance. And that because we are always looking at it from the perspective, management accountant from the accounting from the perspective of a manufacturing, we will do material variances. All right, so that is that. So material cost variance. Material cost variance. Of course, I don't want to break it down now because you do know that to have a material cost, you need a unit multiplied by what the selling price. All right. So if it is unit or quantity multiplied by the selling price, and this one we will split it into two. So material usage budget and material price budget. All right. So we will look at that. You don't need only material when you are producing, you need labor. So we will look at the labor variances. And that one too, we will break it down into two: efficiency variance. All right. So, all right, labor cost variances. We will look at that. So take note of that. All these things are basic. Of course, the next thing we will do is to look at overheads. By the overheads, you know, we have variable overheads. So we look at variable overheads variance. And lastly, we will look at what? Fixed overheads variance. Okay, so variances. So these are what we are going to do to learn the basic variances. Then from the basic variances, we are now going to step into advanced variances. And that is actually the one in your F5 or man accounting or performance management course. So advanced variances. Advanced variances. Now, in the advanced variances, we are going to look at material mix and yield variance. Mix and yield variance. We will look at sales mix and quantity variances. How we will mix up the things to come up with everything. We will look at planning and operational variance and operational variances. And lastly, which is usually not part of the whole thing, but we still have to discuss it. We are going to look at variances so let's say variance analysis in the modern environment. With all these things, whether the basic ones or the advanced ones, at the end of the day, we should be able to prepare an operating statement. So, operating statement preparation. So, this is the entire thing on variances. So this is it, and it is any of this part is going to drop for you for 15 marks. Now, if you are doing basic management accounting, like in Ghana, we do introduction to management accounting. This side should be your focus. And in Ghana, if you are doing management accounting, we call it management accounting. The universities call it managerial accounting. Other people call it performance management. All right, like the ACCAs and stuff. If you are part of those people too, your focus should be on this side. This side. But you see, the truth is that you cannot do this side without understanding this side because there's a knowledge gap. You need to fill it up. So this video becomes what? Very, very important. So now let's look at variances. Let's look at variances. All right. So you see this that I've drawn is the same thing that you see in there. So we start with what? Standard costing, isn't it? Standard costing. We start with standard costing. Everything starts with standard costing. Okay. Now, what is standard costing? I told you that a standard is what? A predetermined stuff. Okay, so you predetermine something. It is a bar on which you measure something with. Okay, so when we talk about standard costing, what we are saying is that it is a cost accounting technique. All right, that involves setting up a predetermined cost for products and services. All right, and you will use that one to compare with the actual. The difference you get is what we call what? A variance. All right, so basically that is what standard costing is about. So what we are trying to do is that we are just trying to set up a cost, okay, a budgeted cost, and we will see. And of course, we have learned so many ways of setting these budgeted costs, and we will see if we compare it to the actual what we have done, because there's no point in doing something when you don't plan. So planning becomes the standard. All right, so you check to know what you have done so far as a person. You need to always have a motivation. All right, so if you check the purposes of, so I told you that from here And please, every part is examinable, so be very, very careful. So here we are talking about the purpose. So that is my first thing, purpose. Then I'll come to some few computations, all right, which we have done using all the costing systems. That's why we learned the costing systems, all right. So now, the purpose is to do cost control. What do we mean? If you set the target, we can able to monitor everything that we are doing, compare the actual to the standard, find out any variances and deal with it. Because of that, you could also say it's for performance evaluation, because if we are able to see what people have done and see the variances, we are able to, give a proper rewarding bonuses and everything to each and everybody. Now, as you could see, it is clearly a budgeted thing because it is a predetermined something you are doing, all right? And it is good for decision making because once the variants are seen, all right, you can make good decisions, all right? That is that. So we also look at the fact that it simplifies records keeping because it reduces complexity in the accounting by making sure that you are eliminating the need to record actual details for every transaction, all right? Because in our offices, what we do is that we book actuals, we book actuals, we book actuals, we book actuals. But you see, sometimes if you are in certain industry, you don't have the actuals happening. Especially, I used to be in the petroleum industry, a BDC, of course, and you have to book the product with the additional cost, even though the additional cost has not even materialized yet. You have to book it. So that's why we call something accrual accounting. All right, you have not paid for it. The actual has not happened, but you accrue for it. That is it. So it makes recording, simplifies record. So you can't say you are waiting for the place you stored your product to give you the invoice before you can do your P&L. No, you can just budget something and put it there. Is that okay? So that all these things we learn, don't make it like it is just about book and you are learning for an exam. When you go for an interview, these are how you express yourself. So understand the impact of what you are learning in the real world of work, all right? So that is that. So it facilitates benchmarking. Why? Because it enables comparison across departments and time periods or similar organization, all right? So it's like saying that it helps you to do comparatives. Okay, so basically that is that. Now, there are a few things that we want to talk about. We are looking at types of the standard cost types. So I told you that we've done the purpose. We need to talk about the types. There are about 4 types. So here you see the basic standard. All right. So we are talking about the benchmark that I said that remains unchanged. It's unchanged. All right. So what you see is that the primary purpose of this is to highlight the trend in factors. So you see that now, this one, we say that it is the minute thing everybody should be able to do. All right. Sometimes you may, so we have attainable standards. We have, so let me even start with this. This one is just the basic level everybody should have. All right. So that is that. It is the basic level. Here, look at it. Basic standards are rarely used and are considered the least useful type of standard because of their static nature. It is the most basic thing everybody should have. So it remains unchanged. It is like that. So the standard is there. It doesn't change. All right. So basically, that is that. Then we have the ideal standards. Ideal standards are saying this is what we call the mission. Everybody wants to get to the ideal. Ideal is like the mission. It's like the mission. All right. What you want to be, the ideal person you want to be. So normally we should not have any scrap. We should not have any wastage. There's no breakdown, no idle time, no stoppages. The perfect environment that is what we are talking about. All right. But you see, the ideal standards are helpful because the truth is that it pushes you to improve. Yeah, it pushes you to improve. Then we have the attainable standards. Attainable standards. All right. So we are talking about the achievable ones. Achievable ones. All right. We call it the attainable standards. We are looking at those most commonly used standard. Why? Because it must be realistic. So it is also called realistic standard. What can you achieve? Even though you are aiming perfection, your vision, what can you actually, your mission, what can you actually do at a particular point in time? All right. So your most achievable or realistic standards, that, because then that is what you can use. All right. So that is that. Okay. Then we have the last one we call the current standard. So your present situation. What is your present situation? Currently, what do you have? All right. What will you have? So we have, these are the present standard. Where you are now in terms of your efficiency, in terms of how good you run the business, where you are now. Right. So that is that. So you see, it's easy, right? So like I told you, this is an easy part you can get a 15 mark for. So right now you see that you have met objective 1. Understand them. We come to objective 2. Standard cost computation. And we have done this one already, so I'm not going to go in there to waste my time. How to determine the cost of a product. Remember, like I said, we've done all these things. Marginal costing focusing on variable, absorption costing also focusing on both the fixed and the variable. In terms of determining gross profit, or what we call contribution, all right? So can we just revise something small? I'm not going to actually put pen to it, but you remember that if you are doing a costing method, you need the prime cost, right? I hope you remember that. So the prime cost being the direct material. And how do you get the direct material? You are multiplying the quantity, right? So here is quantity by what? The price. Good. You get your direct material. Is that not it? So how many quantities are we looking at here? You will see in this question, it is what? 900 units. And what is the price per unit? So you see, it says that direct material, we have 40 square meter here. So if you are looking at this question per se, it means if you want to produce 1 unit, you will need 40 square meter. And a standard cost is always usually for 1 unit of an item, all right? That's why we call it standard cost. So for example, this one, you will need, I can put my CD sign here. And depending on whether I'm doing marginal costing or absorption costing, okay? So here you have the 40 square meter, all right? Square meter multiplying by 5.30. That will give me the price of one. And standard cost is always about 1 unit. The price of a unit, a predetermined cost of 1 unit of an item. All right. So now watch this. If I do 40 square meter multiplied by 5.3, then it means I have 212. That is the price of 1. Of course, not only that, you remember your cost build up. After this one, you need what? Direct what? Labor. Is that not it? So how many hours will we need? So here you need the hourly rate, all right, multiply by the hours worked, all right? So that is that. Hours worked, or hours it will take to work. Now, if you look at this one, do we have the hours? In case of any, you look at this, direct wages. So that is for the labor. In terms of this, we have, it will take you 24 hours and it is price one. Every hour is this. So that machine will go through whatever you are producing. It will go through two process. We have the bonding process, the bonding department, which it will take you 24 hours. All right. Okay, multiplying 5. And it will also go through probably a finishing department. And the finishing department to look at what you have. You will need 15 hours and it is priced at 4.8. So these are some easy understandings you need to get. So now if you look at this, what are you going to get? If you multiply 24 by this in the bonding department, what I get here is 120. And if I multiply 15 by 4.8, that is also 72. Is that it? Usually you should have something like direct expenses, but we don't normally get those things like royalties and all those things. All right, but so straight away, if you add all these things together, you will have what we call the prime cost. Now, remember, in marginal costing, this is marginal, this is marginal. The problem becomes the overheads, all right? That is that. If you are doing marginal costing, then it means that you need to bring in the variable overheads to this top. But this one is more of an absorption costing, all right? So you do something like an absorption costing. So this is it. What is the prime cost? Let's total this and that. So we have 404. That is my prime cost. Then the next thing is my variable overheads. So that is what I was talking about. So here, let me put this one into. So we have variable overheads. Now, since I'm doing the overheads, now in marginal costing, we bring in variable overheads. So variable overhead, whether production or non-production, that's the thing. All right, but we bring in production first just to know the closing stock value. That is it. Then you bring in the non-production, all right, so that you can get your contribution. But if you want to get the close, so go back and watch marginal costing. You see what I'm talking about. All right, so that is that. So the variable overheads, we are bonding the variable overheads being here. So you see, oh, no. These were our direct materials. Is that not it? This is direct wages. All right. So the variable overheads we are bonding. All right. And we have this one. So how do you determine the variable overhead? So budgeted overheads, you remember the marginal and absorption costing thing that we did? Budgeted overheads over budgeted level of activity. All right, so that is that. So what is the budgeted overheads? These are the total overheads. Budgeted overheads, 45,000. Over budgeted level of activity, you have 30,000. So that is that. So budgeted overheads over budgeted level of activity. Now in bonding, how many hours do we need? So this one will give you some value per hour. Then you multiply. In bonding, what do we need? It's 24 hours. So you multiply it by 24 hours. All right. So basically that is that. Now in finishing, budgeted overheads over budgeted. So you have 25,000 over 25,000. So this is cedis, don't forget that. And this is hours. So you get cedis per hour, then you multiply by the hourly hours. So this one is what? 15 hours you need. So you get the value, then you multiply. Now, let's see how it goes. So this one is 36. And this one gives me, oh, this is just one, it's 15. All right, so that is what I have. Now, you've added all your variable overheads. Now, these are variables. If I put these things together, including the variables, I have what we call the marginal cost. Marginal cost. So basically, that is that. This is called marginal cost. Because marginal cost is just a combination of only variables, and these are variables, and direct labor varies depending on, because it's direct, it varies. Material varies because it's direct, it varies. So if you are producing 10,000, you would take material for 10,000. If you are producing 15,000, take material. So it varies. All right. So let's total our marginal cost 404.36. This gives me 455. So this is my marginal cost. Marginal cost, basically. But there is fixed overheads. If I add my fixed overhead to it, then I am getting my total production. All right. So this is marginal. Have you seen that? Total, but somebody could say, let me add the marginal and the everything together to get the total production straight. But you have to separate them because marginal is the combination of all variables. Then we have total, we have what? Fixed overheads, sorry. Fixed overheads. Now, the fixed overhead, you see that we have production, fixed overhead for production and fixed overhead for non-production. All right. So now this is what we did. We did the absorption in there. Now, fixed overhead for production is just 36,000. 36,000. So, and don't forget, we are doing everything per unit. If you don't take care, you make mistake. So if you have 36,000 and the number of units is 900, what will it be? So we have production over 36,900. That gives me 40. So with this, I have my total production. All right. So total production absorption cost. So total production cost per absorption. So that is that. You get it? Right. So now that is it. So per absorption, this is 495. That is the total production. Then you add the non-production. Non-production. The non-production is also 27,000, but per unit. Okay, so 27,000 per unit is 30. So this is what we call the total standard cost. Total standard cost. And the total standard cost will be 525. So if you're doing marginal and absorption costing and there was variable non-production, the variable will be part of the variable cost here, but not variable production. It's just that when you are pricing closing stock, you can't add non-production. So those are the things you need. But visit the marginal and absorption costing, you see what I'm talking about. So this is how we derive it. So what we are going to do now is to learn how to calculate the variance, basic variance for this, basic variance for this, basic variance for this, basic variance for this also. All right, so that is that. So that is how we introduce to you variances. All right, so this is what we did. Of course, you have, and remember, we also did something under flex budget and everything. So you see here, it says that calculate the standard cost. It says, you see all this information, then you have, there is no opening and closing stock. Calculate the standard cost per unit under absorption. All right. Then calculate the standard cost also per marginal. You have done this before, so it shouldn't be a problem. Is that not it? And so quickly, let's go through that. So if you are doing absorption like what we did, absorption costing, you remember that in absorption costing, we will need our sales. So if you are doing the profit element of that, that is it. But let's do cost for now, operating statement. But we are doing, it said calculate standard cost. So we are doing standard cost. So cost, we will need direct materials. And don't forget, standard cost is what? Per unit, standard cost. So materials. And so what is the direct materials that you need? We don't have quantity. So direct material is straight. If you are using absorption costing, you have 150,000, you have it. You will need direct labor, won't you? So direct labor. All right. So you need direct labor. Usually find out. So this means that this is what I'm looking for. The product quantity. So this is the quantity we are looking at. The sales and the production unit. All right. So direct labor. So if we have this and you were doing this thing for this one, you need to be dividing them per unit, per unit, per unit, per unit, per unit, per unit. Is that okay? So you are told that this is the production. So everything per unit. So let's do everything. We cannot divide it by the unit and get 1 for that, the cost of 1. So what will be our direct labor? Our direct labor is 200. So for that, we get prime, which is 350. Prime, which is 350. Now, if you have this one, like we like we did, then we will need our overheads. Overheads. And please, what type of overheads are we looking at here? The production, is that not it? Production overheads. How much is the production overhead? So production overhead is here, is given in twofold. So best, this thing should be like this so that you don't get confused. Yes, so that the fixed will also come up. So that you don't get confused. Because with this, you can clearly see what we are trying to talk about. All right, so that is that. So let me put a colon here. That is that. So you know that these are the production. The production we are fixed in there and we are variable in there. But doesn't matter because we are doing absorption costing. We are not doing variable costing or marginal costing. So here you will say variable, which is 50,000. It's like everything that has been there is there already. So in this one, then you have fixed cost. Fixed cost is also absorbed. So usually you will be doing budgeted overheads over budgeted base. So then you multiply it by the, so it will be the same. If you like, pick 25,000 divided by, let's say the base is 5,000 units and multiply it back, you will get the same thing. So here you have 25,000. All right. So what is the total cost of production? Okay, so you see this one to direct labor hours. I think I need to split this. Okay, so this is it. So this one will help you to do your overhead. So we were not giving the basis for absorbing the what do you call it? The fixed overhead into production. We were not, but everything there is already production overhead. So you don't really need to worry yourself. So if I total this, what do I have? 150. So let's say 350, 400. I have 425. So 425. So that is the total production cost. So that is that. Now, there's no opening and closing. So what is the standard cost per unit? We have 425,000 divided by the units produced here. So 425,000 over 5,000. I get 85 cedis per unit. But if I'm doing marginal costing, fixed cost won't come in. So I will end up having variable. So that is that. So it will be at, my variable costing will be 400,000. We won't add fixed cost. And the unit is, so 5,000 units. So that is 5,840. That should be like 80 cedis per unit, right? So that, yeah, if I calculate, that is what I have. So that is the difference between marginal and absorption costing. So ladies and gentlemen, this is this. All right, so computation of standard cost, but you can be asked to use ABC. You learn how to use ABC. So the objectives keeps going. Now, let's go to the main thing, which is what? Variance analysis. And we are going to use basic variance for now. So basic variance. All right. So let's go to variance analysis. Variance is just a comparison between budgeted and actual. All right. I think because I shifted it. Yeah, there you go. Okay. So let's talk about basic variance analysis. But variance analysis, you need to understand why we call it variance. It's a difference. And the essence is that the variance is just comparing the actual to the budgeted, and it is a budgetary control tool. All right, so understand that. Let me push this thing up here because I keep looking down as if. So let me come up on top of your screen. All right. So you are looking at, it's a key thing because we use it for budgetary control. All right. So we see what you budgeted and we now compare it with the actual. And now we want to make good decisions to appraise people, reconcile, and move on correctly. All right. So basically that is that. So that is it. That is it. And the types of variance, I think we have already gone through. All right. So we have the sales variances. Okay. That is the one that we will start with. We have raw material variances. Okay. We have the sales, we have the sales, the price, and the volume. Okay. So that is that. Raw material to the same thing, labor, variable overheads, and fixed overheads, because these are what come into the cost of a unit. Okay. Of course, like I said, we have the sales volume variance. So the costing system consideration. So these are theories that you have to look at. But we now take the big thing. All right. Let's start with the sales variances. Sales variances, because every profit template starts with sales. So let's start with sales variances. Okay. Now, what gives you sales? There are two things that give sales. Is that not it? Because if you want sales, usually you need the units, the quantity. So the unit is what we call the volume. All right. So that is that. We call it the volume, the quantity. All right. How much you want to sell. All right. Then you multiply it by what? The price. So price. What's price? Selling price. Then you get your sales. Is that not it? That's how we calculate sales. That's how we calculate sales. That's it. All right. So what do we mean by this? Depending on whether we are using marginal and absorption costing, we can actually have our sales variance. It's a very simple sales variances. So look at this. Sales variance. We will be comparing the sales, budgeted sales. So how do we get the budgeted sales? So you have the budgeted sales or the standard sales. All right. Standard means the budget is the same thing. Budgeted or standard sales. It is sales. So how will we get it? We will get our budgeted sales by multiplying budgeted volumes. So budgeted or standard volumes. All right. Budgeted quantity. Okay. Or standard quantity is the same thing. But since we call it standard costing, I'll be limiting myself to standard. Multiply by what? The standard price or the budgeted price. Is that not it? All right, then I will get my budgeted sales. So to do this, don't be surprised to see SQ, which is what? The standard quantity multiplying the standard price. Good. So this is it. It's as simple as that. But be careful, price is determined by the marginal costing or the absorption costing thing that we did. All right. So know the pricing, because when you get your cost, you add your profit element, like these things that we did. You add your profit element, then you get your selling price. So this is how you find budgeted sales. Budgeted sales. All right. But we will be comparing it with the actuals that happen. the actual sales. Actual sales. And how will we find actual sales? Actual sales, we will need the actual quantity that we sold. So we will need actual quantity. Here is budgeted quantity sold. All right. Here we will need actual quantity. Then we will multiply the actual quantity by the actual price. Is that not it? That is it. So you will see that instead of actual quantity we are looking at, we will use words like letters like AQ and what? AP. And the answers that we will be getting, we'll be getting some answers. The answers that we will be getting, we have to compare the answers to check whether there is what? A sales variance. Basically, that is it. Whether there will be a sales variance. All right. So that is that. But you see, do you remember when we were doing the flex budget? Where I told you that we did something like this. If I remember, I think I have my example somewhere here. Yeah, so let's see. I used 200 units and I said it gave us 2,000 with my friend, the Hayes Apparel, you remember? Then at the end of the day, so this was the fixed budget. And at the end of the day, the actual that happened was that we produced 300 units, right? And we spent 2,500. And I said that Hayes will just look at this one and say that he made 500 adverse because he has, in terms of cost, he has spent more than the budgeted. But it is not fair to compare 200 to 300. You remember? And we said that if that is the case, let's find the price. So here, what we did was to do 2,000 divided by 200. And we have 10. And we flexed it with this one. All right. And we had 3,000. And I said, now compare it well. Because you can now see that you check, it is actually 500. He's supposed to actually spend 3,000. And he spent 2,500 and it now becomes favorable. You remember? All right. So this is something that we are taking a good look at. And that is exactly what we are going to do. So here, you will see that you will now have to find the pricing system. All right. You now have to find the pricing system and know the sales price variance also. So if you want what you see here is that if you look at this is our volume variance based on the various analysis. All right. Whether it is absorption or it is marginal. All right. So those are the things. Okay. Now, if we want to find variances between the prices, it is this side. This is the prices. And that is where we will look at. And if we want to find the variances between the quantity, this is what we will look at. So if you are looking at the variance between the quantities, the price is constant. It's held constant. Have you seen that? It's held constant. But if you are looking at the variances between the prices too, then it means that the quantity should be held constant. Basically, it's a simple analysis, right? If I want to find the variances between these two, it means the quantity is constant. If I want to find the variances between the quantities, then it means the price too is what? Constant. Basically, that is that. So you will see a template that has been done here for you. All right. So if you want to know your quantity or volume variance or price variance, it's a simple thing. Make sure, because here we are looking at margin. Margin is kind of a profitability concept, okay? So here, that is what we will be looking at so that we can get the profitability. And that is why you see these formulas like this. So what will be the formula for, what do we call it? Sales volume variance, and what will be the formula for sales price variance? And that is here for you to see. It's very simple. So how do we do that? If we want to say find our sales volume variance, say let's say sales volume variance. It is between our quantities, is that not it? Sales volume. It is between our quantities. And so what we will do, what should we be focusing on? We should be focusing on the quantity side. Have you seen that? Now look at this. If you see these formulas, have you seen that when we are talking about the sales, the SM is kept constant? What is SM? SM, we are looking at margin. And the margin is SP minus CP, which is cost price. And where do we find cost? I told you that you can come here. This is the cost. You add your margin to it, and you have what? Your selling price. That is that. So that is it. So if we are comparing volume, then it means that I will just need the difference between this one and this one. Have you seen that? That is it. That is it. So you'll be comparing your standard. So we have the standard quantity. Have you seen that? Minus the actual quantity. All right. Basically, that is that. Multiply by the, the selling price. Is actually everything is about the selling price. Okay, because we want selling price. Selling price is here. But you need to find the margin before you can get the selling price. And that's why we use the SM. Okay. And the SM is determined using marginal costing or absorption costing. All right. So it's like your contribution. All right. So that is that. Margin is the margin. So it's like your gross profit, you kind of your contribution towards it. All right. So here is what do you need here? You have the SM, let's say, or technically something like the profit on top. Okay, so we have this, and please, this is standard margin. All right, so please take note of that, the standard margin, and it is given by, it's just the contribution. Is that okay? So it is the sales minus the cost, the production cost. And the production cost, be careful, be careful about whether it is absorption costing or marginal costing. So in the book, I personally took it upon myself to use these ones. All right. So basically, that is that. All right. So you have to be very, very careful about it. All right. So that is that. So when you do that, you get your sales volume variance. I want you to understand that it is about the volume. The SM is constant. Then if you want your price variance, it means that now the issue is between your standard. Is that not it? So that is that. So it's between your standard in terms of your price. So you have your standard pricing versus your budgeted prices. Sorry, your actual prices. Now hold on. If I wanted to sell a quantity, the standard quantity of this, let's say here is 1,000. That's what I budgeted to sell. But I was able to sell 2,000. You think it's favorable or it's adverse? Is it favorable? Yes, it is favorable because I was able to do more. So you have to understand it well. The actual price you are selling the thing. So here it will be between your standard price minus what? Your actual price against the actual quantity that you were able to sell. This is it. All right, the actual quantity you're able to sell. Now, what this? If you wanted to sell something at 5 cedis, then you were able to sell it at 4 cedis. Is it a good thing or bad thing? It's a bad thing because you can get more profit. Have you seen that? So basically, that is that. So let's look at this illustration where we learn. So we've done sales. We finished sales variances. It's as simple as that. So you see, this is the formulas you need to keep at heart. It's as simple as that. That is that. All right. So let's look at the illustration. We have the following. The actual sales is here. And we have the budgeted output, all right, and sales standard price is also given. This is the per unit. And we have the budgeted contribution, all right, per unit. The budgeted profit is this. So what is missing? Margin. Is that not it? Margin is missing. Is that not it? It's missing. All right, so that is that. And this is your profit. And the profit, remember, we talk about profit as your margin. Okay, so when we talk about the thing, we are looking at the profit element, the profit element that is on the thing. All right, the profit element. And it says that we should use this thing using under marginal and absorption costing. All right. What do we have here? Actual sales. This is the budgeted output. Interesting. Let me take some water, okay? I'll be back. So we are meant to do under absorption. So in absorption, what did we learn? It is everything. The cost structure includes direct labor, direct material. Then you absorb the variable overhead. Then you also absorb the production overheads. All right. So that is what gives you absorption. So that one you get profit. Everything is in. But in the marginal costing, you get contribution. So it is direct material, direct labor, then all the variable overheads, then you get contribution. So we call marginal one will be contribution. So here is marginal. All right. So if we want to compute the sales volume variance, all right, sales volume variance. Do you remember the formula? That if we are doing the sales volume, we will need the budgeted quantity minus the actual quantity. Then we are multiplying it by what? The margin. And the margin is what we call under absorption, the profit element. Okay, so that is that, the profit element. So the budgeted profit is here, and here we call it the contribution. So what do we have? We have budgeted output, which is 900, but we are able to actually sell 1,000. All right, and per days, we will have to pick the absorption, which is 205. But if we are doing it here, to be 900 minus 1,000 multiplied by what? 245, because that is the contribution. All right, so that is that. So if you check, let's go up. So here I said contribution, I said profit. All right, so you have to be careful about them. Right, so that is that. Learn it well, you understand. So here we are left with 100, and that is what you see here. So it is 20500. And this one too, you have 24,500. Now, what does it mean? Is it adverse? Is it favorable? You need to do that. You budgeted to sell 900. You're able to sell 1,000. So it is good. It's actually a favorable thing. Here too is favorable. It's as simple as that. Is that not it? Yeah. But let's also do the pricing. The pricing. All right, because this is the actual sales. This is your budgeted selling price, the standard, and this is your actual. So that one too, it will be what? Standard price minus actual price. What are we multiplying it by? The actual quantity. I hope you remember, actual quantity. Now the actual quantity we have is 1,000. So what is the price? Here we don't do anything marginal, or so it's just straight up. So how is it going to be? What it is going to be is that the standard price is 700, but you sold it for 650. That one alone, the multiplication is constant, so it doesn't affect anything. So what tells you is that between this and this, there is an adverse relationship. So whatever answer that you have, like this 50,000, is adverse, all right, because you were not able to achieve what you wanted to do, all right.